Every year, the United States government makes billions of dollars available to ordinary Americans through programs, credits, accounts, and matching schemes that most people either do not know exist or assume are too complicated to access. This is not conspiracy theory content. This is not clickbait. These are real, documented, government-sanctioned financial benefits that millions of eligible Americans leave completely unclaimed every single year. Not because they do not qualify, but simply because nobody ever told them the money was there. Today, we are breaking down the most significant sources of free government money available to Americans right now, what they are, who qualifies, how to claim them, and exactly how much you could be leaving on the table every single year by not knowing about them. Number 1, the employer 401k match. You are not capturing the single most universally available piece of free money in the American financial system is the employer 401k match, and it is the one that the most people fail to fully capture. If your employer offers a 401k match and you are not contributing enough to receive the full match, you are leaving a portion of your compensation on the table every single pay period. Not metaphorically, literally. Your employer has set aside money specifically for you, and you are choosing not to collect it. Here's how it works. Most employers who offer a 401k match will contribute 50 cents for every dollar you put in up to a certain percentage of your salary, commonly 3 to 6%. If you earn $60,000 per year and your employer matches 50% of contributions up to 6% of your salary, that means your employer will contribute up to $1,800 per year into your retirement account, but only if you contribute at least $3,600 yourself first. If you contribute less than $3,600, you receive less than the full match. If you contribute nothing, you receive nothing. That $1,800 per year in employer match contributions invested over 30 years at an 8% average annual return grows to approximately $220,000. $220,000 from money your employer was always prepared to give you, simply because you contributed enough of your own money to unlock it. The employer match is the closest thing to a guaranteed 50 to 100% return on investment that exists anywhere in the financial world. Not capturing it in full is one of the most expensive financial decisions a working American can make. Action step: log into your HR portal today and confirm your current 401k contribution rate. If it is below the percentage required to capture your full employer match, increase it immediately. Number 2, the Earned Income Tax Credit. Most low and middle income Americans miss the Earned Income Tax Credit, commonly known as the EITC, is one of the largest anti-poverty programs in the United States and one of the most consistently unclaimed tax benefits available to working Americans. In 2024, the IRS estimates that approximately 1 in 5 eligible Americans fails to claim the EITC every single year. The average credit for eligible filers is over $2,000. For families with 3 or more qualifying children, the maximum credit exceeds $7,000. The EITC is a refundable tax credit, meaning that if the credit exceeds the amount of taxes you owe, the government pays you the difference directly. This is not a deduction that reduces your taxable income. It is a direct payment into your pocket from the federal government for which you qualify simply by working and earning within the eligible income range. For 2024 single filers with no children, earning up to approximately $18,600 qualify. Single filers with 1 child, earning up to approximately $49,000 qualify. Families with 3 or more children, earning up to approximately $66,800 qualify. Married filing jointly filers have higher income thresholds across all categories. The most common reasons eligible Americans fail to claim the EITC are believing they do not qualify, not filing a tax return because their income was too low to trigger the filing requirement, or simply not knowing the credit exists. If your income falls within the eligible range and you have not been claiming the EITC, you may be able to file amended returns for up to 3 prior years and collect the credits you missed. Action step: visit the IRS EITC Assistant tool at irs.gov to determine your eligibility in minutes. If you qualify and have not been claiming it, contact a tax professional about filing amended returns for prior years. Number 3, health savings account contributions and the triple tax advantage. If you are enrolled in a high-deductible health plan and you do not have a health savings account, you are leaving one of the most powerful tax-advantaged savings vehicles in the entire American financial system completely unused. A health savings account, or HSA, offers what financial planners call a triple tax advantage that no other account in existence provides. First, your contributions go in pre-tax, reducing your taxable income in the year you contribute. Second, the money grows completely tax-free inside the account. Third, qualified withdrawals for medical expenses are completely tax-free. No other account, not a 401k, not a Roth IRA, not any other savings vehicle, provides all 3 of these tax benefits simultaneously. For 2024, individuals can contribute up to $4,150 to an HSA. Families can contribute up to $8,300. If you are 55 or older, you can contribute an additional $1,000 as a catch-up contribution. Those contributions reduce your taxable income dollar for dollar in the year they are made. But here is the feature of HSAs that most people completely miss. The money in an HSA does not expire. It rolls over indefinitely year after year. And once you reach age 65, you can withdraw the money for any purpose, not just medical expenses, and pay only ordinary income tax on non-medical withdrawals, making it function exactly like a traditional IRA in retirement. The strategy that sophisticated investors use is to contribute the maximum to their HSA every year, invest those funds in index funds inside the account, pay current medical expenses out of pocket while saving the receipts, and then decades later reimburse themselves tax-free from the HSA using those saved receipts. The result is a powerful additional retirement account funded entirely with pre-tax dollars. Action step. If your employer offers a high-deductible health plan with HSA eligibility, open your HSA today and begin contributing the maximum. If your employer contributes to your HSA, that is additional free money on top of your own contributions. Number 4, unclaimed property, sitting in state databases right now. There is a category of free money that most Americans do not know exists, and that requires nothing more than a name search to potentially find. Every state in the United States maintains an unclaimed property database, a registry of dormant bank accounts, uncashed checks, forgotten security deposits, abandoned investment accounts, insurance payouts, and other financial assets that have been turned over to the state after a period of inactivity. The total value of unclaimed property held by state governments across the United States is estimated at over $70 billion. These accounts become dormant for entirely ordinary reasons. A person moves and forgets about a small savings account at a local bank. A utility deposit is never refunded, and the company eventually transfers it to the state. An inheritance check is sent to an old address and never cashed. A former employer issues a final paycheck that never reaches the employee. A life insurance policy pays out, but the beneficiary is never located. The money does not disappear. It sits in the state database indefinitely, waiting to be claimed by its rightful owner or heir. Claiming it is free, requires no lawyer, and in most cases can be done entirely online in under 30 minutes. Action step. Visit missingmoney.com or your individual state's unclaimed property website and search your full name, any previous names, and the names of deceased relatives. The average claim is several $100s. Some claims run into the thousands. It costs nothing to check. Number 5, the Saver's Credit. Almost nobody knows about. The final piece of free government money on this list is one of the least known tax benefits available to low and moderate income Americans who are actively saving for retirement. The Retirement Savings Contributions Credit, known as the Saver's Credit, provides a direct tax credit of up to $1,000 for single filers and up to $2,000 for married couples filing jointly simply for contributing to a qualifying retirement account. The Saver's Credit is available to single filers earning up to approximately $38,250 in 2024 and married couples filing jointly earning up to approximately $76,500. The credit is worth between 10 and 50% of your retirement contributions up to $2,000 per person, depending on your income level. Lower income filers receive a higher credit percentage. This means that a married couple earning $50,000 per year who contributes $2,000 each to their Roth IRAs, a total of $4,000 in retirement contributions, may qualify for a $2,000 direct tax credit simply for saving money they were already planning to save. The credit is applied directly against their tax bill, reducing what they owe dollar for dollar. The reason most eligible Americans never claim the Savers Credit is simple. They have never heard of it. It does not have a marketing campaign. It does not appear in financial influencer content. It is a quiet, genuine government incentive for lower and moderate income Americans to build retirement savings. And it goes unclaimed by millions of eligible filers every single year. Action step. If your income falls within the eligible range and you are contributing to any qualifying retirement account, including a 401k, Roth IRA, or traditional IRA, confirm with your tax preparer that you are claiming the Savers Credit on your return. The money covered in this video is not a loophole. It is not a gray area. It is not reserved for the wealthy or the financially sophisticated. It is documented, legal, government-sanctioned money that exists specifically to benefit working Americans. And most of it goes unclaimed simply because most Americans were never told it was available. Capture your full employer match. Check your EITC eligibility. Open and fund your HSA. Search the unclaimed property database. Claim the Savers Credit. Do all 5, and the financial impact on your life this year alone could be genuinely significant. If this video helped you find money you did not know you would hit that like button, it helps Kraftwise reach more everyday Americans who deserve to know what they are leaving on the table. Subscribe for a new money video and keep building the financial life you deserve.